Well, inflation may look like a problem that will go away, but it's more likely to persist and lead to a crisis in the years ahead. That's the warning from economists at Deutsche Bank. Now, Deutsche Bank says focusing on stimulus while dismissing inflation fears will prove to be a mistake, if not in the near term, then in 2023 and beyond. Well, Bismarck Rewane, CEO of Financial Derivatives Company, will help us make a sense of this warning by Deutsche Bank. Good morning, Mr. Rewane. Thank you for joining us.
Good morning.
Good morning. Thank you for having me.
Now, this warning, no doubt, points at the Federal Reserve and its new framework in which it will tolerate higher inflation for the sake of a full and inclusive recovery. And we know that most central bankers, including Nigeria's central bank, seem to be focusing on growth rather than inflation targeting. Here in Nigeria, we have seen inflation gallop to over 18%. How would you contextualize this warning by Deutsche Bank as it concerns Nigeria in the inflation dilemma we face right now?
Thank you. The truth is that let's look at the facts. The facts are that Deutsche Bank is a bulge bracket firm. That is one of the leading investment banking firms in the world. Two, that Deutsche Bank's view is not exactly consistent with those of the consensus economists. What Deutsche Bank is saying is that the inflation argument today is that inflation is transitory, whilst Deutsche Bank says it's much more structural than transitory. And that if nothing is done in the short run, that by the year 2022-23, we will have inflation unraveling. And the consequence of that is that we'll come back to fight it with very high interest rates, and it will lead the world into a recession. This happened in the 70s before, and which led to very high interest rates. Interest rates in the US got as high as 18% per annum under Paul Volcker, and the world went into a deep recession. So they are warning that this could happen. However, let us look at inflation. Inflation assumes that money supply grows at a particular rate while production is growing at a much slower rate, and that it also assumes a full employment framework. The truth today is that there's high unemployment in the US and all over the world because of the pandemic. Therefore, the quantitative easing and the purchasing of assets by the central banks is not just going to stabilize the economy, but also is going to unlock unemployed resources. To that extent, the inflation rate that you're going to be seeing today, I think is coming out tomorrow in the US, is about 4.7%. The threshold for US inflation is about 2%. In the UK, inflation has gone from 0.7 to 1.5%, double the rate. So we are seeing inflation at about 11-year high. But the truth is that these are transitory inflationary problems, and that over time, in the next 6 months or so, it will slow, inflation will moderate. So that's the global thing. But now let us look at Nigeria. Nigeria is almost fully integrated with the global economy. Never mind what's happening with our problems with Twitter, which is an unfortunate development. We are saying that the Nigerian economy is integrated with the global economy. However, if you look at Nigerian inflation is 18.12. We are projecting that inflation goes up to 18.21 when the numbers come out on the 15th. The inflation numbers do not seem to gel with the anecdotal evidence, as you can see. But there are structural issues in Nigeria as well as transitory issues, as well as supply bottlenecks. So you see, for example, the price of onions has spiked because of the strike. The price of beef is going to spike because of the cattle thing. But there's money supply problems in Nigeria. Money supply in Nigeria is going at 20.2%. That is M2, whilst your output is going at 0.5%. So to understand it and for viewers to understand it and simplify this, what you are saying is that the amount of goods in your economy has increased by 0.5%, but the amount of money you have printed is grown by 20%. Obviously, naturally, that would be a big price problem. I think that has to be clearly understood. But that's not the only factor that is stoking inflation. There are exchange rate pass-through, there's insecurity, there's all other issues about commodity prices and the relationship between energy price, the price of petrol, and the price of goods. I don't know if I've answered the question, and
All right, Mr. Rewane.
Some other things.
So that means you don't see
Yes.
the marginal drop that we saw in inflation. We don't see that trend actually continuing.
No, it will not. It will not continue in the short run. It will. Inflation is going to moderate towards the end of the year. I tell you why. We are going into the planting season, but this year, this planting season, we have farmers consuming their seeds and their grains. Normally, you consume your grains and you plant the seeds. This time, they are eating some of their seeds and eating some of the grains, all of the grains. Therefore, the next harvest, you will see a lower harvest because some of the seeds are being consumed as food. Now, that's one. Two, we are going to have an adjustment in electricity tariff. We are going to have an adjustment in petrol pricing. We have already seen an adjustment in the exchange rate. All of these things mean that costs are going to increase, but output will increase subsequently because these structural issues and policy issues are going to unlock some investment and some output. So what I'm saying is that in the months of May, June, and July, you will see higher inflation, but around the month of August, we'll see it slowing down. Secondly, the NBS says categorically that 58% of Nigerians reduced the amount of food they consumed in the last quarter, while only 26% reduced the amount of non-food items that they consumed. Therefore, consumers are beginning to resist high prices. They are beginning to bulk. They are beginning to substitute for cheaper products. In fact, as a matter of fact, they are even beginning to consume less. That is another thing that can help to moderate inflation.
All right, Mr. Rewane, just a quick one before we let you go out there. Of course, you've noted that what we're seeing in the global space is a transitory inflationary pressure there. However, it seems what we have here in Nigeria is persistent. Now, taking it from the global space, where do you see the risk of or risk on the currency?
Well, you see, the currency is, there's an exchange rate and there's an exchange rate determining mechanism. What you have seen today is an adjustment of the exchange rate. The mechanism for determining and keeping the exchange rate in fair value, in equilibrium, constantly includes a number of policy strategies that are some unpleasant, some pleasant, but you have to do it. I suspect that the Central Bank of Nigeria is going to adopt a crawling peg strategy to bring the value closer to fair value. What you saw about a week ago was the exchange rate went to 502, 504. It has come back now to about 498, 495. And it begins to converge gradually because the exchange rate has been delayed. And therefore, you are going to see this, but it's going to be painful. It's still, when compared to what it was last year, when the exchange rate was 440 and the price of oil was as low as 35. Today, the price of oil is $72, and yet the exchange rate is depreciating. So there are some things that need to be fixed, and I'm sure the central bank will be figuring out how to fix this. But the exchange rate determining mechanism is just as important as the exchange. The exchange rate is a number. The mechanism is a policy package.
All right. Thank you very much for your time this morning with us, Mr. Rewane. We do appreciate it.
Thank you.
Thank you for having me.
So Nigeria has missed